October 29, 1929, the day the markets faced their biggest test in history. Fast forward to October 29, 2025, when some projections suggest Nvidia could reach $5 trillion in value exactly 96 years later. History doesn't repeat, but as they say, sometimes it rhymes. Today, we're going on a journey to explore how global markets evolve through remarkably similar patterns, from the roaring 20s all the way to a hypothetical 2025. We'll look at margin debt, central bank decisions, and the psychology of investor behavior. And most importantly, we'll uncover one timeless lesson from John D. Rockefeller that still matters more than ever in today's fast-paced world. So, if you love stories where history meets finance, hit that like button, smash subscribe, and let's dive right in. Let's rewind the clock to 1929. The air was thick with optimism, the economy was booming, and everyone wanted a piece of the action. Investors borrowed heavily, using what was then called call loans to leverage their bets and join the seemingly endless stock market party. Companies like the Radio Corporation of America, or RCA, were the tech leaders of their day. They represented the future, with soaring expectations built on the revolutionary promise of radio technology. Just like today's AI giants, RCA was a symbol of innovation, and its stock price reflected that unbridled enthusiasm. The public couldn't get enough. Stories of ordinary people becoming millionaires overnight fueled the frenzy, and margin debt ballooned to unprecedented levels. It felt like the good times would never end. But as the year progressed, cracks started to appear. The market, which had seemed invincible, began to show signs of weakness. It made a series of sharp adjustments, shaking the confidence of even the most bullish investors. In an attempt to stabilize the situation, a consortium of key banks, led by figures like J.P. Morgan Jr., stepped in to support stock prices. Their initial efforts brought a temporary rally, a moment of relief that some mistook for the end of the turmoil. However, the underlying sentiment had already shifted. The optimism that had powered the market for years began to evaporate, replaced by a growing sense of fear and uncertainty. The foundation was crumbling, and the great unwinding was just beginning. Now, let's jump forward in time to our projected 2025. In this scenario, Nvidia has achieved a record valuation, becoming a titan of the global economy. Sound familiar? Just as in the 1920s, margin balances are hitting new highs as investors borrow to amplify their exposure to a soaring market. And in the background, shifts in interest rate policy from the Federal Reserve echo the monetary patterns of the past. When you place the chart of RCA from the 1920s next to Nvidia's projected trajectory into 2025, the visual parallel is striking. Both charts show a near vertical ascent, a parabolic move driven by a narrative of technological revolution. One was powered by the promise of connecting the world through airwaves, the other by the promise of artificial intelligence reshaping our reality. But looking behind the headlines of this hypothetical 2025 reveals a more complex picture. We see record-breaking corporate spending on AI infrastructure, but at the same time, earnings reports from other sectors are starting to show mixed results. This creates a divergence, where a handful of megacap stocks pull the entire market higher, while the broader economy shows signs of slowing. Volatility, once dormant, begins to pick up as traders start hedging their bets. As we watch the Nvidia logo morph into the old RCA symbol, we're reminded that market narratives are... The excitement around AI today is immense, but the patterns of human behavior and market dynamics remain remarkably consistent across generations. One of the most powerful parallels between these two eras is investor leverage. Borrowing power has always been a major force shaping market cycles. In the 1920s, investors used credit from brokers to buy stocks on margin, often putting down as little as 10% of the purchase price. It was a high-stakes game that amplified both gains and losses. Today, that same mechanism exists, but it's more accessible than ever. With just a few taps on a smartphone app, a retail investor can access significant margin, leveraging their portfolio in ways that were once reserved for the wealthy elite. While the technology has changed, the fundamental principle and the risk remains the same. High levels of leverage make the system more fragile, turning a simple correction into a potential cascade. Another striking parallel is the sheer power of technological optimism. Every generation finds its breakthrough technology, a revolutionary innovation that promises to change the world. In the 1920s, it was the radio. This incredible device was going to connect every home, deliver news and entertainment instantly, and create entirely new industries. Investors poured money into companies like RCA, believing they were buying a piece of the future. Fast forward to 2025, and AI has taken that role. It's seen as the engine of the next industrial revolution, capable of solving humanity's biggest problems and unlocking trillions in economic value. Both narratives captured the public's imagination and drove valuations to dizzying heights, fueled by the belief that this time is different. And of course, we can't ignore the role of central banks. When monetary policy shifts, markets are forced to adjust. It's a recurring theme that spans the century. In the late 1920s, the Federal Reserve began raising interest rates to cool down what it saw as speculative excess in the stock market. This tightening of credit had a profound impact, contributing to the market's eventual downturn. Today, we watch the Fed's every move with the same intensity. Decisions on interest rates and quantitative easing directly influence market liquidity and investor risk appetite. Comparing the Fed's policy statements from a century ago with those of today reveals a consistent challenge: how to balance economic growth with financial stability, a tightrope walk that has defined modern finance. Global trade dynamics also play a crucial role. Policy timing often defines the start or end of a market cycle. In 1930, the United States passed the Smoot-Hawley Tariff Act, which raised tariffs on thousands of imported goods. This protectionist move is widely seen as having worsened the Great Depression by sparking a global trade war. Fast forward to our modern era, and we see similar tensions playing out. Trade agreements are constantly being negotiated. Tariffs are used as geopolitical tools, and supply chains are being reconfigured. The timing of these major policy decisions, whether it's the renewal of a trade pact or the imposition of new restrictions, can have ripple effects across the entire global economy, impacting corporate profits and investor sentiment. So, what can we learn from all this? The story of John D. Rockefeller during that period offers a powerful lesson in resilience. While many were caught up in the speculative frenzy, Rockefeller had already shifted his focus. He strategically diversified his wealth, moving out of an overconcentration in oil and into more stable, dividend-paying assets and a broad portfolio of smaller, promising ventures. He wasn't trying to time the top perfectly. He was building a financial fortress designed to withstand any storm. Today, savvy investors are studying similar strategies. They understand that true wealth isn't just about capturing explosive growth. It's about balancing that growth with robust risk management to ensure long-term stability. Looking ahead, what are the signals we should be watching? Here are 3 bonus insights. First, pay attention to slowing growth data. Reports like the Fed's Beige Book can give you a real-time feel for economic activity on the ground, often before it shows up in official GDP numbers. Second, keep an eye on the housing market. Housing is a major driver of the economy, and signs of pressure, like falling sales or rising inventory, can be an early warning of broader economic weakness. And third, watch fiscal spending trends. Government deficits and debt levels can influence long-term interest rates and inflation, creating headwinds for the market down the road. Ultimately, the modern warning sign is this: when enthusiasm reaches a peak and valuations seem detached from fundamentals, it's worth remembering that stock prices reflect stories as much as they do numbers. The narrative around a company like Nvidia is incredibly compelling. But the parallel with RCA serves as a powerful reminder that no stock and no market goes up forever. When the story becomes more important than the balance sheet, it's a time for caution, not euphoria. So, what do you think? Are we living in a new golden era of innovation, or are we witnessing the rime of another major market reset? Let me know your thoughts in the comments below. And if you want to dig deeper, I've put together a free comparison sheet with key data points from both ERAs, which you can grab from the link in the description. Thanks for watching. And if you enjoyed this journey through financial history, don't forget to like this video and subscribe for more weekly stories where history meets finance.